In this video, I'm going to take you through the four most common ways in which private equity funds sell their investment into companies. The first is a trade sale. The second is what we call a secondary. The third, an initial public offering. And the fourth, a vendor buyback. Let's start by looking at what we call a trade sale. This is the most common form of selling a business from a private equity fund. What it relies on is that there are much larger companies in the same space that are always interested in buying smaller companies to add to their existing business. The second most prevalent way a private equity firm sells its investment in a particular company is through what we call a secondary sale. It's a strange term because what it means is simply selling a company which this private equity firm owns to another private equity firm, but a much larger private equity firm. The third way in which a private equity firm chooses to sell its investment in a particular company is, of course, the IPO, or initial public offering. What that means is that the business has achieved a level of scale and profitability and good corporate governance sufficient to attract interest from the Australian Stock Exchange. The fourth way in which a private equity firm sells its companies is a vendor buyback. It usually means that for whatever reason, the journey of the private equity owner, in conjunction with the original owner who stayed in the business for 20 or 30% of the business, has reached a natural end point. And roughly 10% of all private equity firms' investments in companies are resold back to the people that they bought them from in the first place.